Hello, my friends. Welcome back. In this month's market update, we're excited to share some of the most promising news that we've had for you in months. We spend a lot of time talking about interest rates, inflation, and have even touched on a potential recession. Well, unfortunately, a U.S. recession is quite likely next year, says former Boston Fed President Eric Rosengren. Rosengren told CNBC that to stem inflation, the Fed funds rate may need to rise to 5.5% or higher, which is much higher than the level currently expected by investors. Rosengren also said that the unemployment rate would need to rise between 5 and 6% nationwide. We know that these interest rates are a key factor in the economy. They can be used to control inflation and influence our economic future. The Federal Reserve controls these interest rates by adjusting the federal funds rate, which is the rate that the Fed charges banks for short-term loans. The Federal Reserve's Board of Governors' primary goal is price and dollar stability. The Fed uses monetary policy, i.e. changes in interest rates, to achieve these goals, but it also monitors other economic indicators such as unemployment, inflation, and GDP growth. Many home buyers are misunderstanding what this means for them, however, and they're losing out on leveraging the market appropriately. Zillow reports that according to a recent survey, real estate agents agree that the top misconception among home shoppers is that home prices will fall significantly. In fact, Zillow's data indicates that a sharp decline in prices is highly unlikely, and frankly, I agree. According to Zillow's forecast, home values will flatten over the upcoming year, followed by prices rising a modest 1.3% by September 2023. According to 43% of the study, active buyers are now inserting extra contingencies into their offers, which have been overwhelmingly foregone over the last 2 years. These include items such as inspection contingencies and appraised value conditions, which are typically included to protect buyers from unforeseen expenses. But sellers are also making mistakes. According to the same report, 81% of real estate agents believe that it's typical right now for sellers to anticipate receiving multiple offers on their home, when that's unlikely to happen. Another 79% of sellers are asking above market value for their houses still, and 74% don't think they should lower their asking price. This is why real estate agents are overwhelmingly having tough conversations with their sellers to set realistic expectations. For these same reasons, active home shoppers have much more power and leverage than they think. As rates go down and other folks who had put the buying process on hold choose to re-enter the market, the leverage is likely to swing back into the seller's favor. That may be only 2 or 3 months from now. Today's home shoppers who leverage this dynamic appropriately may just end up hitting the sweet spot. In fact, the latest statistics from Realtor.com show that the number of residences for sale has actually increased nationwide by 33.5% since this time last year. Nationwide, houses are staying on the market an average of 64 days, which is 19 days longer than this time last year. Due to this change, sellers are now more likely to finally start setting competitive property prices. A year ago, buyers were engaged in unprecedented bidding wars, waiving contingencies and making cash purchases while sellers were in complete control. But despite stubborn sellers, the tables have turned. In fact, 92% of property sellers are agreeing to certain buyer-friendly conditions like those valuation and inspection contingencies. While a majority of would-be shoppers are still sitting on the sidelines waiting for rates to go down or for prices to crash, the latter of which will not happen, those willing to act now are going to be reaping the benefits when the bidding wars reemerge a few months from now. Alex has more on this in the Consumer Corner. Alex, it's all yours.
Hello, everyone, and welcome back to the Consumer Corner. With the news that inflation is finally starting to slow down, we can all take a momentary sigh of relief. Feel free to join me. Now, back to the news. We're 2 years into our version of the Roaring '20s, and yet again, we're facing unprecedented times. We're all going to be affected by the market changes that the Federal Reserve is attempting to use to try and tune up our economy. Some, though, are feeling the changes a lot more than others. I don't think most of us would expect just to really understand what they're trying to do in this one pivotal area. So today, we're going to cover an unexpected correlation: corporate layoffs and the cost of your home. For many, the idea of unemployment rates going up can seem somewhat frightening. More people with no jobs just sounds like a recipe for problems. Believe it or not, though, having a certain level of unemployment is genuinely good for the economy. With the cost of living in the past 18 months skyrocketing by levels we haven't seen before, economists are advising us that increased unemployment is a good sign, a sign that the cost of living will eventually come down to a more comfortable level. Simply put, an unemployed economy spends much more slowly than an employed economy. On a fixed income, the day-to-day necessities we have to buy use up more of our paychecks than they used to. And if we need to take out a loan or put things on a credit card, the interest rate is higher than it once was, and that makes us think twice about spending that money. Most of us will choose not to play the high interest game and not spend that money, unless you're highly interested into getting into more debt than you can handle. So we deal with what we have for now for a little bit longer. Companies have raised wages over the past 2 years to somewhat match inflation, and along with super low unemployment rates, many increased wages to further match their competition. Add the cherry on top that many of those companies took on slower sales and damaged supply chains due to COVID, and you've got a very unhappy Sunday. Think of this like an unemployment version of the real estate bubble. It looked great, but there were more people with more money spending it on less things. That's part of what made costs skyrocket in our lives, aka inflation. This unique storm of elevated living costs, competition, and a recovering market, these all pointed to an end we should have easily predicted. And that's the corporate layoffs we've been seeing all over the news. From companies as large as Amazon, Meta, Twitter, Tesla, Walmart, Pfizer, Eli Lilly, and all the way down to the many real estate brokerages nationwide, people are being handed out pink slips like we haven't seen in a long time. It is truly heartbreaking. Real estate prices may be a silver lining to show through this all. People becoming unemployed removes potential home buyers and investors from the home buyer, compounded by elevated rates from our lovely friends at the Federal Reserve. These people that are still employed and are still spending money are just spending it on one less thing. This has curbed demand farther than expected. With lower demand, sellers are finally coming down on their prices, and many are even offering rather generous concessions to get deals done. For those who can still weather the storm, it has built the perfect conditions for buying in some parts of our nation. As some might have heard, rates will go down. Home prices are not likely to decrease much more, though, after this correction, at least not compared to how much they're expected to jump once rates go down and shoppers all re-enter the market at roughly the same time. Make sure to watch for new bidding wars and price jumps when that happens. That's the sign that rates are finally coming down. Now remember, there's an eye to every storm, and the data suggests we might be in it right now. Landing in the best possible financial situation before the winds change takes the right team. If you're looking for that team and think it's time to strike, don't hesitate to reach out to us, y'all. Thanks for coming into our corner. Now back to you, Chris.
Thank you, Alex. Now, this is all the more important as both rents and home prices still stand at relative all-time highs. In fact, the average American family brings in about $90,000 per year, according to the census. The NAHB Wells Fargo Housing Opportunity Index said that just 42.2% of homes sold since the beginning of July could be afforded by families making that $90,000 median annual income. That's a nationwide statistic. But here locally, buyers looking to finance the typical DFW house need an income of about $87,000 to qualify, according to a new report from the National Association of Realtors. The DFW median household income is just under $76,000. If you're expecting the local market to crash or even for home prices to reduce by 10% or more, I'm sorry to tell you that won't be happening. Not only for the reasons we've outlined about the market reversing as soon as rates do, but also, one, demand for rentals is increasing annually, which will drive renters to explore home buying further, increasing competition with those already shopping. Two, Dallas has an ever-expanding economy and increasing population growth year after year. Three, no state capital gains tax on income from property sales is going to encourage savvy young professionals, possibly a lot of those who have recently relocated, to continue looking into the housing market to take advantage of these tax breaks. These are all the more reason that those out home shopping right now will come out ahead. They're using rate mitigation techniques like 2-1 buy downs, where the seller sets aside money to use to temporarily discount the buyer's payment. For a buyer qualified at 6%, this means their first year payment would actually be based on a 4% rate when utilizing this technique. When rates subside, we'll be working with those new homeowners to do rate reduction finances, so they're still going to get the best market rate once it's favorable anyway. At the same time, those who choose not to buy now and are going to wait, well, they're going to have to put up with the return of bidding wars and overpaying for houses, which sounds less stressful to you. Anyway, that's it for this month. Let me know any thoughts, questions, or anything you thought we got wrong. Anything you think we should cover next time. This is Chris Shoemaker, and I'll see you next month.